Okay, next one is the balance sheet. Remember we said balance sheet is going to be a point in time, right? Usually every end of every quarter, like 3/31, June 30th, September 30th, December 31, we give the balance sheet, right? And it shows the total, all the assets we have and how much we've got. Cash. How much is in the cash account at that date? How much do customers owe us on that date? What is my inventory left on this date? What's the value of my equipment on this date? How much do I owe the bank on this date? All of that. So it's a given point in time. So let's take a look at that. Now this balance sheet identity is very important. I've showed it to you guys a couple times before. This is probably the most important equation in accounting, is assets equal liability plus equity. Accounting does something like this. I'll give you guys just a little preview of this, and maybe we'll have time to work on the workbook stuff later. Accountants have to record business transactions. So for example, let's say that we sell the iPhone for cash, right? So in this case, what happens is we have an account called sales, which you guys just saw. Sales is going to go up by 1,000. This is an equity account because equity account relates to profits. That's the owner's profit, right? And if they gave us cash, cash is an asset account because it's valuable. And the cash also goes up by $1,000. Right? So this is what we call double entry accounting. Every business transaction is like that. Now, remember we said we used to have this in inventory, right? Before we sold it, the iPhone was in our inventory. It was an asset, right? So our inventory is going to go down, right? And say we sold, our cost was $750, right? It should be a 750, right? And our cost of goods sold, which is an expense account, is going to be 750 also. Now, expenses reduce equity, right? So this is the double entry accounting that we have to do, you guys. So every transaction involves at least 2 accounts. In this case, it was 4, because when we sell merchandise, we have revenue, right? And we have our cost of buying that thing, right? Then we have whether it was cash or whether credit card, and our inventory has to go down. And this thing always balances, you guys, right? Always balances. So look at this, the equity is now up by 250, right? If you subtract those, it's 250, and the assets are up by 250, right? It balances. That's why we call it the balance sheet identity. So after every business transaction, the accountants are entering this in, and this thing has to balance at the end. If it doesn't balance, it tells us something's off, right? Okay, so assets relate to capital budgeting. Remember, these are investments. Think of assets as investments. We bought these iPhones, right, because we're going to generate a profit when we sell it, right? So it's an asset like that. So that's just a little bit of an overview here. Now there's some things, other things you should know about the balance sheet here. So the general order of the assets is an order of liquidity. We said liquidity is how fast we can turn it into cash. So cash is the most liquid asset. So cash is going to come first. Then we have things like accounts receivable. Accounts receivable is money that customers owe us. And we usually collect that fast. So that's like number 2. Then we have like inventory and so on and so forth. The fixed assets come later, like the cars, the equipment, the building, because it's not easy to sell that, not liquid. And then we have current assets, which we talked about before. These are assets that are going to be used up or turn into cash in less than a year, right? Cash is already cash. This turns into cash when we collect it. So it's going to turn to cash this year. We're going to sell the inventory this year. Supplies, right? Supplies start off as an asset. like pens, papers, staples, toner for the printer. All of that stuff is an asset that will get used up in a year. So they're all current assets. Fixed assets last for more than 1 year, right? Last longer than a year. Buildings, cars, machines, airplanes, all of that stuff. And then, so that's the assets, you guys. Then on the liability side, we divide them into current, right? These are the bills we have to pay this year, right? And long-term liabilities, like the car loan, maybe we have to pay this over 5 years. Now, a car loan, you guys, this is a little bit tricky. A car loan is, say, 5 years, right? So, and say we make monthly payments. So then the payments on the car this year are a current liability. The payments that occur on the car loan after this year are long-term liability. So actually some are part current, part long-term. But our credit card, for example, is a current liability because we're going to pay it this year. These are long-term loans like a mortgage on your house, things like that, or you're building for your company. And we already discussed this one too, remember? In the beginning, net working capital is our current assets minus the current liabilities. We want that to be greater than 0, right? Because if this one is bigger, then we run out of cash because the cash comes from here and we're going to use it to pay these bills over here. And the other thing to keep in mind, you guys, is that the balance sheet is book value, not market value. Let me just explain that briefly to you. So I'll just show you guys the whiteboard for a second here. Okay, so we buy a car, you guys. A car is an asset. It goes into the car account as plus 100,000. And you guys said before that the car will last for 10 years, right? So depreciation expense on the car every year is going to be 100,000 divided by 10 years is equal to 10,000 per year, right? So at the end of year 1, we have something called accumulated depreciation, which is the total depreciation since we bought the car. What's the accumulated depreciation on the car after 1 year, you guys? What is it? We depreciate 10,000 per year. So after 1 year, the accumulated depreciation is 10,000, Mohammed, exactly. So this is 10,000. If we subtract these two, we get the book value of the car. This is the book value. Book value is now 90,000. At the end of year 2, the asset is still 100,000. We don't directly reduce the car value itself. We keep it at its historical cost. What's the accumulated depreciation for year 2, you guys? What's the accumulated depreciation? 20,000, Mohammed, exactly. It's year 1 plus year 2, right? This 10,000 plus another 10,000. So far total depreciation is 20,000 and the book value 80,000. Now, book value does not equal market value. We can sell the car at the end of year 2. And what we actually sell it for is the market value. So say we sell it for, at the end of year 2, we're going to sell it for 90,000. The sale price is the market value. We had a book value of 80,000. So did we have a gain or a loss, you guys, on the sale? Is that a gain or a loss? Gain or a loss? Yeah, exactly, a $10,000 gain. And guess what? Uncle Sam is going to take, he's going to take a cut of that. Exactly, $10,000 gain. But the point here is that what we do for accounting is only the book value. These are book values done by the accountants. There's different ways of depreciating assets. We can use accelerated depreciation, in which case we can get this number to go up bigger, right, in the beginning, which causes our expenses to go up and our taxes to go down, right? But that has nothing to do with the market value. The market value is the market value. That's what you can actually sell it for. So if you're going to buy another company and you look at the balance sheet and you see, oh, the book value of their car is $80,000, so I'll give you $80,000 for that. They'll be like, no, it's worth $90,000, right? Or no, maybe it's only worth $50,000. You have to independently assess the real market value of those assets, because the stuff you see on the balance sheet is only book value. It's only based upon accounting rules. It doesn't mean it's going to sell for that. So just remember that. That's important. Not the only thing that's important, but that is important. Yeah, so the book value is the least value to sell. No, you can sell it below book value, in which case you would have a loss in that case. But if you have a loss, you would get a tax deduction from that. So that's okay. Okay, you guys, let's go back now forward. So here's a real balance sheet for you guys. And we have to split it into two, it's so big. So notice here we have, this is an order of liquidity. Cash is first, then marketable securities. This is securities we bought in the short term because we didn't want to leave it in the bank. So we invest some in short term in the money market, right? Like treasury bills, short-term loans to the government to make a little bit of money on this. Accounts receivable, this is money people owe us. Inventory, this is the things we're going to sell. And those are all current assets. Then we get into the fixed asset. Here's our land and buildings, machines, equipment, furniture, vehicles, right? Other financial leases. And we've got total gross fixed assets. Gross fixed asset means before depreciation. Then we subtract the depreciation of all this stuff, right? And we get the net book fixed assets, which is the book value. This is the book value. And then total assets. So total assets, you guys, are going to be equal to the current assets plus the fixed assets. And we can see that the total assets here are going up or going down. From 2014 to 15, is it going up or going down? Yeah, so it's going up. Exactly. Let me see what your comments were here. Yep, up. That looks good, you guys. Mohammed, Liza, Khalid, Sarah, good job. And Ahmad and Mohammed, good job. Okay, yeah, exactly. So we're looking for this to go up. That's a good sign. It means the company's investing in assets. Now we get into the liabilities and the equity. And we get into a little bit of water. Okay, again, this is in order of what we have to pay first. We have accounts payable. Right, this is money that we owe short-term. Notes payable is also short-term borrowing that we've done. Then we have accruals. This means things like money we owe to the workers that we haven't paid yet. So for example, if we pay the worker bi-weekly, say we paid them on December 14, right? December 14's paycheck is for December 1 to December 14. Then we pay them again December 28th. December 28th's paycheck is from the 15th to the 28th. The next paycheck is going to be somewhere like January 10, right? However, accounting rules said, wait a second, how about the 29th, the 30th, and the 31st, right? they worked on these days, so we owe them money, right? So we should accrue what we owe them here. So this is money that we owe that we didn't pay them yet. So in accounting, we'll do our double entry. One is going to be a wage expense, right? And the other thing is going to be wages payable, because we need two entries here. The payable means liabilities go up and expenses went up. So that's kind of what's happening here, something like that. Then we have long-term debts, you guys, debt that we have to pay back after a year. Then we get into the preferred stock, the common stock, which is equity, right? So this is preferred stockholders, money that they gave us. This is money common stockholders gave us. And then we have other money that common stockholders gave us. We won't go into detail with this paid in capital, you guys. But basically what happens, I'll give you a simple example with the Romco. Right? Remember, Romco's share price was 32. Usually companies have a par value for their stock. It's a made up number. Usually we can call it like one SAR. Let's call it 1 SAR for Romco. So 1 in par value means the addition besides the par is 31. This is the additional paid in capital. The 1 goes into the common stock accounts and the 31 goes into paid in capital. Not a big deal. The reason this is useful, notice this one is 250 par, right? If you divide 191 by 250, you can compute the number of shares, which is nice because when you're doing a ratio like earnings per share, we have to know the number of shares. That's why I find this useful. Okay, then at the end, we have to add together liabilities plus equity. Because remember the balance sheet, you guys, we have to show that assets equal liabilities plus equity. And you can see here, this is 3597. And if we go back here, this is 3597. So we're in balance. This one for 2014 is 3270. And this one for this year is 3270. Now we lost our writing, which is unfortunate, but I'm sure you guys memorized that, right? Let me see if you guys have any questions here. Yeah, so Kali, what's the difference between preferred stock and common stock? Basically, preferred stock, I don't know if you guys ever saw the movie Wall Street. There were several Wall Street movies. I'm not talking about The Wolf of Wall Street. I'm not talking about Wall Street Money Never Sleeps. The original Wall Street with Oliver Stone, Charlie Sheen, Michael Douglas, is back in 1987 or something. Everyone on Wall Street watches this movie. Anyway, Michael Douglas plays this corporate raider in the movie. He's somebody who goes and buys up companies that are underperforming, and then he splits it off and sells off the assets for a profit. And he's on the phone in the movie, right? And he says, you know, why is this guy giving lectures? He doesn't know the difference between preferred stock and livestock, you know, like animals. So preferred stock, you guys, basically, this is a hybrid equity that looks like part debt and part equity, because it looks like debt because notice this is 100 par preferred stock. So for every $100 of preferred stock that you buy, you get a guaranteed dividend of 5%, right? The 5% looks like a debt because debt gets interest, right? And that looks like interest, but it's not interest, it's a dividend. So, but it's a stock that's made to mimic debt, right? So it has ownership equity, unlike debt. So debt has no right to the profits of the company, but preferred stock and common stock do, right? So this is it's part debt and it's part equity. So it's a hybrid thing. Also, it comes before the common stock. So if the company goes bankrupt, you guys, these guys get the money back first, these guys get the money back second, and the common stock gets the money back third. So there's less risk of the preferred stock than the common stock. But the return is going to be lower as well because of that lower risk. Okay, see if there's any other questions here. Otherwise, we'll keep going. Yeah, how can you guarantee the balance sheet is balanced? I'll explain that one. Leonardo DiCaprio movie is The Wolf of Wall Street. That was good because it's based on a true story, and I like these finance movies. But this one I'm talking about, you guys, is check it out. This one is just called Wall Street. It's not The Wolf of Wall Street. It's worth renting somewhere. Wall Street. This is 1988, something like that. Very good movie. A lot of ethics here, you guys, or lack of ethics. Okay, now how does the balance sheet balance, you guys? The accounting, remember, is double entry, you guys. So what the accountants actually do, let me just show you guys this briefly, because we're kind of giving an overview of this. So accountants actually follow these steps. Number one, they're going to put things into a journal, right? And this is the double entry bookkeeping, right? So remember we said before, it looks something like this. I'll give you guys an example. We do a debit, the cash of 1,000, and we do a credit to sales of 1,000. Right? For every transaction that happens, they do this for the whole month. Then they do some adjustments, right? There's things that are not business transactions. I'll give you one example here. We debit depreciation expense for the car, right? Is going to be 10,000. That's a lot. And accumulated depreciation is going to be a credit of 10,000. Right? Then they do this, something called this trial balance, you guys. So the purpose of the trial balance, right, after they do the posting, you guys, sorry, there's a posting here, post to ledger. So they take all of these transactions, they move them into the ledger. The purpose of the ledger keeps track of how much cash do I have after this transaction? How much total sales do I have for the month? What's my total depreciation for this month? My total, so it keeps track of the balances. These are the balances, right? But because when you move it from this journal, right, to the ledger, these things are going in separate directions. This goes into the cash account, right? And this piece goes into the sales account, right? Because you're separating these off, there's a chance that you make a mistake. Right? That you record one as 10,000, the other as 1,000. And that's the purpose of this thing, you guys. This thing adds up. It shows all the accounts like cash, right? Sales, and it shows the balance in each of these accounts, right? And it shows depreciation expense, 10,000. Accumulated depreciation is 10,000, right? And it's got a total here that shows, 11,000, 11,000. If this thing doesn't balance, it means potentially your balance sheet will not balance. If this thing balances, then you just take the balance sheet information from here and you complete your balance sheet. And then your balance sheet will balance. But if this thing doesn't balance, your balance sheet won't balance. So there's a lot of checks and balances that happen behind the scenes. And eventually when you get to the end, you do your income statements, right? And balance sheets. These are the financials. You run the financials. That's like the last step, number 8. And there's other steps in between. So that's generally how you guys do it. So if you follow all those steps, it will balance. But I do a basic accounting class also, and yeah, the students, I make them do all this stuff. And a lot of them don't balance because it's a learning process. But eventually they get it.